Now there's several differences between debt and equity. Debt, as we know, is all borrowing incurred by the firm, whether a bank loan or a bond issuance, and is repaid according to a fixed schedule of payments. So for example, in a bond, we had the bond's indenture, that bond's contract, that specified that coupon interest payments as well as principal repayment were going to be made and when they're made, so according to a fixed schedule. But equity holders, on the other hand, they receive cash flows that are subject to the firm's performance. So if the firm is not performing well, it doesn't have to make payments to the equity holders, whereas regardless if the firm is performing well or not, it must make those scheduled payments to its debt holders. Unlike creditors, holders of the equity, in other words, the stockholders of the firm, they are owners of the firm. And as owners of the firm, they have voting rights. For example, voting rights to elect the firm's directors, and the firm's directors in turn select the managers and monitor the managers on behalf of the shareholders, as well as voting on several special issues. One example would be the decision to be acquired, to accept an offer to buy them out. Stockholders have voting rights in this area, whereas bondholders would not. Debt holders, though, the bondholders, they're not particularly interested in control issues or voting. What they're interested in is receiving their promised principal and interest payments. Other differences between debt and equity is the order of payment. So we refer to equity holders as the residual owners of the firm. That is, they get paid their cash flows. In other words, they receive a portion of the cash flows after all other claimants have been satisfied. So equity holders only get paid after bondholders and bank loans and governments in the form of taxes and employees. Equity holders only receive a portion of the cash flow after all other claimants are satisfied. Another difference between debt and equity is that, unlike debt, equity capital is a permanent source of finance. So when we think about the maturity on debt, whether it's a 10-year bond or a 20-year bond, that debt obligation has a fixed life. At least in theory, the maturity on equity financing is infinity. There's no maturity date, and equity never has to be repaid by the firm. There's also a difference in tax treatments. Interest payments to debt holders are treated as tax-deductible expenses. At least they are under current U.S. law. Whereas the dividends, in contrast, that the company pays out, they're not tax-deductible. In fact, if we think of that income statement, dividends are paid out of net income after taxes and interest expenses have been made. The firm makes a decision how much to be paid out in dividends and how much to be reinvested back in the firm. That's the dividend long-term decision that we talked about earlier. And the tax deductibility of interest makes debt less expensive than equity. In fact, there's two things. There's the tax deductibility of debt makes it less expensive than equity financing, and then there's the fact that debt is less risky than equity, which makes it a lower cost financing option. If the company is unable to meet its scheduled debt obligations, in other words, the interest payments as well as a principal repayment, it can be forced into bankruptcy. And according to U.S. Securities and Exchange Commission, in bankruptcy, assets are divided up as follows. First, the secured creditors. These are the secured bank loans or the secured bonds are paid first. Second in order is going to be the unsecured creditors. So this will be the unsecured bank loans or the unsecured bonds. Suppliers or customers, they're going to have the next claim. And then finally, after everyone's left over, in the case of bankruptcy, the equity holders would get what's left over. However, in practice, because of legal costs and costs associated with liquidation, equity holders typically receive nothing in a bankruptcy proceeding. Now, that's the order set out by the U.S. Securities and Exchange Commission, the SEC. However, in practice, the order of payment can be quite different, as we saw during the 2008-2009, the financial crisis, and the bailout of the automobile industry, where there was the sense that unsecured creditors were paid ahead of secured creditors.